Okay, very good morning to everyone. So Thursday the 26th of January, and just taking a look at the charts this morning. As you can see, when US continued after we left from the European close yesterday, the Trump train continued. We have gapped up again in the DAX this morning, similar fashion to yesterday, where following on from the US lead. And when people have asked me before, kind of newer traders, about how does each kind of continent lead into the other, and really it's about assessing what is the macro driver, and undoubtedly that is still Trump at this point, and has been now for a number of weeks if not months. And so it's definitely the US that's dictating terms at the moment. And so these record closes across the major three indices yesterday, that kind of fed through into the Asian session, which was equally positive as well. And as such, then European equities playing a bit of catch up this morning. The DAX, you can see in the centre left, just gapping up. A quick run up through the cash open to have a look in the futures, getting close towards 11,900. A quick look as well at R1 this morning. Consequently, you can see bottom right, T-notes already below the low point of yesterday's session. So fixed income just trending lower already this morning. If I look at bonds, we're already down around 33 ticks as well. So a kind of repeat of, I'd say, slightly more moderate risk on to what we had yesterday. But still a similar situation. Higher equities, higher yields, lower fixed income futures, as people have still got quite a healthy appetite in the equity market. The dollar seems to be gravitating to 100 in terms of the currency markets. And with that, there hasn't been too much movement in the major pairs, but the one standout has been cable, still outperforming comparative to euro dollar, which has seen slightly negative. But that mild risk on also then slight reverse of the flight to quality kind of bid in gold, which broke yesterday, of course, at 1200 level, and we still reside slightly negative territory, down $2 this morning. So not really too much in the way of new pertinent news to get you up to speed with. More so it's about a digestion of the equity move and the Dow Jones. And I've kind of marked up this chart here. We're going to have a quick run through of the Dow, the S&P, and make a bit of sense of what's happened, because that was where most of the questions that were directed to me yesterday were on that subject. And most of the press this morning is talking about the reasons why we're up at these levels. So I've got here marked is the actual election itself. So that's that night with the biggest, or that day, the biggest wick to the downside, when we had that large bout of volatility over the election night. We sold off 5%. Globex futures electronic trade overnight. Before then, the kind of rally took hold after we hit that limit down, and through Wall Street, the conciliatory tone from Trump, and then this Trumpflation kind of trade that's taken hold. The move then from where we were at the low to where we are currently, you're looking at a 15% move in the Dow over that period. So it's a phenomenally quick rally to get to that point. A couple things then to look at here. We all know about the kind of overall premise for this, the kind of commitment, or the look to lower considerably corporate tax, potentially trying to have maybe even a short-term window to garner repatriation flow from a lot of large sums of money sat offshore by large corporations in the US, like Apple, for example. The other thing being infrastructure through this kind of stimulus and fiscal spending and projects such as we've heard in recent days from the Trump administration, and then various deregulation, whether that's in the financial sector in particular, where we've had the likes of Goldman Sachs rallying, way outperforming this Dow move. They're up, we're talking more like 30% plus, if not much more than that. So there's a lot of positive catalysts there for corporate America, which I think is key. And then technically, you'll remember that when we got into kind of the Christmas season, so once we started to break that early December move above this kind of, well, really it's that 19,500 type level. We've then consolidated in an extremely tight range. I remember quoting a couple of stats when we came back for January, and we were talking about the fact that there hasn't for a long time had such a narrow price range. The same could be said for the S&P. So just looking at that here, after we had that big ramp up, when we got to, again, similar mid-December, we were kind of locked in price action. We had a brief move just into year end, and then it got even tighter. That price action you can see there since really January, there was absolutely nothing really going on in the S&P. But the combination then of the expectation of this Trump trade, in addition to these technical breakouts that we've seen, S&P you can see here from yesterday, and then I'll go back to the Dow. Yesterday as well, 20,000 was obviously the big barrier which we fell short of at the end of last year. And if you remember the futures market and the way we were trading ahead of the cash equity open yesterday, it was almost as if we were just trending higher, slowly higher and higher and higher. There wasn't any new news at that point. Not even Trump was saying anything new. But what you often get is when there's a psychological target the market has in mind, and everyone starts banding around 20,000. You could definitely sense that sentiment on Twitter. Is people are just almost just carrying the market, wanting to test it. And then when the cash market opened at 2:30 yesterday on Wall Street, we obviously opened above it, and then we saw a bit of an extension from thereafter. So it'll be interesting to see now whether technically, given 20,000 was so important as a barrier, does it now act as a bit of a floor for the moment? With that, obviously, playing that trade out means that in terms of fixed income, this was what Piers was looking at yesterday with you guys. So that whole play of economic stimulus lifting growth potential in the US and ultimately increasing price pressures, which would be met with higher inflation, so yields creeping up. We're about a point away from what would be a very critical level in US Treasuries. So definitely that's something to be mindful of in the coming days and weeks once we get to that point, 22 and a half, which was that low that, just don't forget the time frames I'm looking at on this chart. Those lows there defined the low from 2013 end of and beginning of 2014. So we've not been at these levels for a number of years. Any break below there, we're looking at a yield kind of level or treasury price level that we've not been at since really the summer of 2011. So definitely an interesting test could be coming soon in the treasury market. One of the things though with this equity move that I was asked yesterday was, well, really quite frankly, why on earth are we at 20,000? When Trump's talking about pursuing what ultimately is a very protectionist plan, isn't this ultimately going to end badly? And I think at this point in time, what you've got to understand is that I totally appreciate and I agree with what your feelings are, is that actually the relationships by making America great again at the expense of the relationships with other world trading partners is ultimately going to be a very tricky one for the US to handle. But I think what's happening at the moment is that you've got a difference between the micro and the macro longer term. And on the micro, I'm talking about US corporate profitability. If you look at Boeing yesterday, their shares were up as much as 4.5%. You've also had some other good earnings reports of late. And the premise being is that fundamentally, lower corporate tax, heavy stimulus on infrastructure on the fiscal side, then definitely these are going to impact underlying profitability for corporate America. And it's going to give them an artificial sharp, shot in the arm, if you like, an injection of profits and increase their outlook. You had SAP doing so, Alibaba, everyone's benefiting from this situation, whether or not they're even a US company, but if they've got a highly leveraged market within that space geographically. And so actually what you're getting, I think, is people are just trading the here and now. Now, this is not to say then ultimately once this plays out in the longer term, you start to see when he addresses issues such as the relationship with China, for example, and how that then might create a bit of a negative. The other thing to factor in here is that you've got Trump calling down the dollar. Now, if you remember, probably about 6 months ago, or really when the the market was focused on the Fed hike in December, so going through Q4 really of last year, what you had was a really strong dollar. We kept moving higher and higher and higher. Trump was people were trading this Trump trade, and people were trading the fact that then the Fed would have to respond with multiple hikes going into 2017. Now what's happening is Trump has actively looked to talk down the dollar. And if you look at the dollar performance from the beginning of 2017, I think I saw a stat, it's something like 3.5%. The dollar has depreciated actually. That again is another positive force for corporate America, because if the dollar's too strong, it starts to create a general headwind for a number of export type names. And so actually you're almost fueling the fire further with the equity move and the fact that you can step in and verbally intervene in the currency, which Trump himself did, as well as some of his other administrative team. So that's also at play. The key here on whether this really lasts, I guess, is that so far we've heard about yesterday, the Mexicans are going to have to pay for the wall. It's going ahead as far as Trump is concerned. But let's not forget, short term, that's going to create thousands of jobs, and also they've got to get paid, they're going to get more money, they'll spend it, and so on. This is that artificial short-term boost. So that's the border tax. You've also had the commitment on what has been really a trigger point for maybe some short-term belief that Trump can deliver, was the pipeline deal, the Keystone XL pipeline. That kind of flipping and reversing what was the kind of bellwether staple of Obama's presidency on the environmental front just got turned in 48 hours. What we haven't heard yet really is any details about concrete fiscal plans. And if he doesn't address this, I think week 1, week 2, the longer it gets, the more nervous the market might get in taking this trade any further with more kind of an aggressive move. Because that's ultimately where the real power will lie, and whether this move can be sustained more aggressively to the upside. A byproduct of this, though, just taking a quick look at a couple of charts that I thought were quite interesting. And let me just show you the VIX. And I think to put into context, you have to look at the VIX over really 2016 into where we are at the moment. It puts into a bit of context where we are in terms of the market's view of how much risk is there. As you can see then, we had June, July. Of course, you know what happened here. That was the biggest surprise really of 2016. That was the vote for Brexit. So a spike in hedging of volatility. 20 is often seen as the kind of the artificial line, if you like. Once we cross 20, markets tend to view that as we've now crossed over the barrier into a highly kind of uncertain environment. And you can see that acting out technically over the period of September. If you remember September, there was the uncertainty about can the Fed deliver with their rate hikes. They ultimately didn't at that point, and they had to reference or remove their dot plot projections. And then you had the elections, and you can see here in terms of a surprise value, yes, it was a surprise that Trump had won, but the VIX never got anywhere near as high as what we had with Brexit, which ultimately was a bigger surprise. The market was a little bit better prepared for the what-if scenario with Trump, but certainly volatility or protection against that did spike at that point. What I want to go into now, though, is look where the VIX is trading at the moment. And if I look at 3-month chart, this is the election you can see on the left-hand side. Look at where the VIX moved to yesterday. And actually, the VIX at 10.72 hit its lowest level since July of 2014 and is now getting closer to its all-time low territory. So in terms of the market's perception of risk at the moment, This is why it's kind of so bullish, equities, is because people's outlook, short term at least, is definitely very optimistic on what Trump can deliver. Now, this is not, if you get looking at other barometers, there is the volatility of volatility, which is the VVIX, which is then you're hedging against potential volatility in the volatility index, and actually that has been seeing some movement. So this is where you've got the timeline between people are risk on now. In a few months' time, though, there is some protection against potential increases in volatility as some of the other more pressing or important fiscal elements of Trump get discussed. And also political risks, obviously, forthcoming of Brexit and European elections. Another good chart that I did see, and you probably read in your research this morning, it's quite just an interesting stat here. You're looking at Deutsche Bank's analysis of the years it's taken between 1,000-point changes in the Dow Jones index. So it's been the quickest ever between round number 1,000-point increments, as it's only taken 64 calendar days to go from 19,000 to 20,000 in the Dow. Now, obviously, the percentage changes get smaller the bigger the number becomes, but the average length of time has normally been 1.9 years. We've done it in 64 days. Incredible. If you look at the way that, obviously, for the last periods of thousands here that we've gone through, monetary policy, QE, and so on, but obviously that time frame there from 19 to 20,000, very, very quickly comparative to these other previous periods of those levels at 9,000, 13,000 for sure. So very quick move, but that old saying my mum used to tell me, the faster something moves like that, or the bigger they are, the harder they fall. Who am I to say the timing's on that? But certainly I think at the moment you cannot, you can have the belief that yes, ultimately there might be some kind of failure to deliver ultimately by Trump. At least his pursuit of protectionism policies might come a cropper, if you like, with international and global relationships. But you've got to trade the here and now and what's in front of you. And ultimately, we're risk on at this present point. A quick look in currencies. I did want to look at cable. We saw a very important technical level breached yesterday, which was that 125.56. That was that key resistance which was holding the price action for this week, really. At break of that, you can see a very quick extension of the move, and we've trended higher ever since. Cable outperforming Eurodollar this morning. Putting a longer term chart, though, it does bring into an interesting focus here the context of where we are. Now, this chart here, you can see Brexit happening, the biggest intraday spike on record. We were then actually, that 128.06, I think it was, that low post-Brexit was really fundamentally key, or technically key, on that break that we had on the Tory conference back in early October. The flash crash, you'll remember, we're way over that now. We've had a recovery of sorts into the end of last year. We got close, you can see, to that 128.06. So that's a real key level upside, that 128 handle really. And then we went lower again. This was when we gapped to 120. We briefly broke that low print on the flash crash. 120 psychologically acted as a level, a strong one. That was when we had the weekend Theresa May, we want to leave the single market. She then, after strategizing a very clever way of kind of prepping the market up, delivered a very authoritative speech, higher inflation in the UK, clarity on Brexit. We've gone through the Supreme Court ruling, Houses of Parliament will get a say, and here we are, sterling continue to recover in the opposite force. The dollar has, as we said, has been weakening on the back of a concerted effort by Trump and his team to call the dollar lower, further fueling this recovery. What I'd say then is that actually I still feel quite bullish in cable for the moment, at least until we get up to these 128 type levels. I think then we start to get a little bit interesting as to where this will go. I think 128 for me is going to define really the top side of this recent run up higher. So I think we might get another point or 1.5 points out of this move But ultimately, I think there needs to be a little bit more clarity now exactly with the bill that the UK will bring forth in order for the timings then to ultimately, can they trigger Article 50 by the end of March, which I still think is the case, despite the ruling that happened from the Supreme Court. So that's the kind of state of play at the moment. As I say, there's not too much new news. We're still trading, I'd say, the same sentiment as we were yesterday. So I'd act accordingly in terms of your setups and strategies for today. Looking at the UK, actually taking the pound into consideration, looking at the calendar, we do have Q4 preliminary GDP for the UK. So we're looking at 0.1 moves lower against previous. Looking on the charts then, 0.5 on the year-on-year, that will put us down from a consecutive 0.6. One thing I'd keep in mind is that if you've been looking at your Bloomberg articles over recent weeks, most economists at the banks who were surveyed at the beginning of the year are anticipating a gradual slowdown in UK economic growth as we go through this political transition period, this negotiation of Brexit. Now, they're not expecting a drop off a cliff, but they are expecting marginal 0.1, 0.2 decreases. So I don't actually think it's going to be that surprising if that does materialize today. And I don't think a 0.5 reading, if that comes in line, albeit a slowdown from the prior reading, wouldn't hamper my thoughts that I still favor a more long bias for the time being, definitely in the context of what has been a weakening dollar as well. But keep an eye on that. That's at 9:30 alongside mortgage approvals. Afternoon, you get your regular jobless data from the US, Chicago Fed National Activity Index, wholesale inventories, service PMI, new home sales. Again, a couple of flashpoints of interest, none of this of which I think is going to detract from the broader driver, which at the moment is definitely the Trump trade and the equity focus. Again, one thing you probably noticed yesterday was when we discuss so often about what is potentially the best asset to trade, I think yesterday was definitely one when there's a massive psychological kind of level that everyone's looking at. It's almost self-fulfilling, and other traders around other asset classes that it might be trading are all watching the same thing. And when that happens, actually, as equities, you've got to look at as for your lead driver of markets. Now we've breached that level, maybe that's lessened, but certainly if we start to get a pullback back towards 20,000, it's going to be key as to will this now act as a solid support level on the reversal now that we've broken it. So that's definitely something to look out for later when Wall Street opens, given that the Dow finished in the cash last night at 20,067, basically. Okay, guys, going to leave it at that. So have a good session. As per usual, I will see you in the chat room. Have a good one.